Why paying off your student loans should be a priority. Financial benefits you need to know. Student loan debt has become a major financial issue for millions of people across the United States. With the high cost of tuition, fees, and living expenses, it's no surprise that so many graduates are burdened with thousands of dollars in student loan debt. However, the impact of this debt can be long-lasting, affecting not just the borrower's financial health, but also their personal and professional goals. I'm excited to introduce this book on the importance of paying off your student loans. Whether you're a recent graduate or a seasoned professional, this book provides valuable insights and strategies for managing and repaying your student loans. From the financial benefits of early repayment to the long-term impact of student loan debt on your financial health and career advancement, this book offers a comprehensive guide to managing your student loans and achieving financial stability. The strategies presented in this book are practical, actionable, and designed to help you make the most of your resources and minimize the long-term impact of student loan debt on your financial health and overall well-being. In addition, this book highlights the importance of taking action and making paying off your student loans a priority. While federal loan forgiveness is always a possibility, it is not a guaranteed solution. By prioritizing your student loan debt and taking action to pay it off, you can achieve financial freedom and minimize the long-term impact of student loan debt on your life and career. I encourage you to read this book, take advantage of the valuable resources and strategies presented here, and make paying off your student loans a priority. By doing so, you can achieve financial stability and freedom, and take control of your future. Chapter 1: Introduction. Student loan debt is a national crisis that affects millions of Americans. According to recent data, over 44 million people in the United States carry a total of $1.7 trillion in student loan debt. The burden of this debt can have a significant impact on individuals and the economy as a whole. While student loans are a necessity for many people to achieve their educational goals, they often come with high interest rates and long repayment terms. This can create a significant financial burden, making it difficult to achieve other financial goals, such as buying a home, saving for retirement, or starting a business. The Federal Student Loan Program was created as part of the Higher Education Act of 1965. The purpose of the program was to increase access to higher education by providing students with low-interest loans to help pay for college. Over the years, the program has evolved, and today it is the largest source of student loans in the United States, providing billions of dollars in loans to millions of students each year. The availability of student loans has undoubtedly played a significant role in the skyrocketing cost of college tuition in the United States. With easy access to student loans, colleges and universities have been able to raise tuition and other fees at an alarming rate, often leaving students with significant debt burdens upon graduation. Unfortunately, this increased cost has not translated into a higher quality of education, and many students are left feeling as though they have not received a return on their investment. Instead, the higher tuition has often gone to enriching college staff and administrators and paying for fancy campus buildings, rather than improving the quality of education or providing more resources for students. As a result, many students are now questioning the value of a college education and whether it is worth the high cost and long-term debt burden that haunts them for years. The amount of time it takes to pay off a student loan can vary widely depending on several factors, including the amount of the loan, the interest rate, the repayment plan, and the borrower's financial situation. On average, it takes about 20 years for borrowers to fully pay off their student loans. However, this time frame can be significantly shorter or longer, depending on the factors mentioned above. Some borrowers may be able to pay off their loans in as little as 5 to 10 years, while others may take much longer, especially if they are only able to make minimum payments or fall behind on payments. It's important for borrowers to carefully consider their loan terms and repayment options to develop a strategy that works best for their individual circumstances and goals. Additionally, the program's complexity and lack of transparency can make it difficult for borrowers to fully understand the terms of their loans, leading to confusion and financial difficulties. Finally, the federal student loan program has faced criticism for its failure to provide adequate relief for borrowers facing financial hardship or struggling to repay their loans. The emotional impact of student loans can also be significant. Many borrowers experience stress, anxiety, and even depression as they struggle to keep up with their loan payments. For some, student loan debt can become a source of shame or guilt, which can further compound the problem. In this book, we will explore why paying off your student loans should be a priority. We will discuss the financial benefits of paying off your loans early, the consequences of defaulting or deferring your loans, and strategies for managing your loans and accelerating your repayment. We will also examine how student loans can impact your long-term financial health, your career choices, and your personal well-being. By the end of this book, you will have a comprehensive understanding of why paying off your student loans should be a priority, and the strategies you need to achieve this goal. Whether you're just starting to repay your loans or have been struggling with them for years, the information in this book will help you take control of your financial future and achieve the benefits of being debt-free. Chapter 2: The Cost of Student Loans. Understanding the cost of your student loans is crucial to making informed decisions about repayment. In this chapter, we will discuss the key factors that impact the cost of student loans, including interest rates, accrual, and the impact of loans on credit scores. The interest rate on your student loans is one of the most important factors that impacts the cost of borrowing. Federal student loan interest rates are fixed by law and can vary depending on the type of loan and when it was disbursed. Private student loan interest rates, on the other hand, can vary widely depending on your credit score and other factors. Interest accrual is the process by which interest is added to your loan balance over time. If you have a loan with a 5% interest rate and a $20,000 balance, you will accrue $1,000 in interest in the first year. If you make only minimum payments on your loan, this interest will be added to your balance and will continue to accrue interest itself, compounding the cost of borrowing over time. Your credit score is a measure of your creditworthiness and is based on your credit history. Student loans can impact your credit score in several ways. Late payments or defaulting on your loans can significantly impact your score. On the other hand, making on-time payments can help improve your score over time. Managing the cost of student loans. While the cost of student loans can be significant, there are strategies you can use to manage these costs and pay off your loans more quickly. These include making larger than minimum payments. Making larger payments than required can help you pay off your loans more quickly and reduce the overall cost of borrowing. Refinancing or consolidating loans. If you have multiple loans with high interest rates, you may be able to consolidate them into one loan with a lower interest rate, reducing your overall cost of borrowing. Choosing the right repayment plan. Federal student loans offer a variety of repayment plans, some of which may be more affordable than others. Choosing the right repayment plan for your financial situation can help reduce the cost of borrowing. Avoiding deferment or forbearance. While deferment or forbearance may be an option if you're struggling to make payments, these options can significantly increase the overall cost of borrowing. If possible, it's best to avoid these options and make on-time payments instead. Chapter 3: Building a Repayment Strategy. Managing your student loan debt can be overwhelming, but creating a repayment strategy can help you stay on track and pay off your loans more quickly. In this chapter, we will discuss the key components of a successful repayment strategy, including setting goals, understanding your repayment options, and creating a budget. The first step in building a repayment strategy is setting goals. Determine how much you want to pay each month and how long you want to take to pay off your loans. Set realistic goals that take into account your income, expenses, and other financial obligations. Understanding repayment options. There are several repayment options available for federal student loans. These include standard repayment, a fixed monthly payment amount over a period of up to 10 years. Graduated repayment, a repayment plan that starts with lower payments that gradually increase over time. Income-driven repayment, a repayment plan that is based on your income and family size. This includes several different plans, such as income-based repayment, pay-as-you-earn, and revised pay-as-you-earn. Extended repayment, a repayment plan that extends your repayment term up to 25 years. Private student loans may have different repayment options, so be sure to check with your lender to understand your options. Creating a budget is an essential component of any repayment strategy. Start by listing all of your income sources, including your salary, freelance work, or side hustles. Then, list all of your expenses, including rent, utilities, groceries, transportation, and other bills. Subtract your expenses from your income to determine how much you can afford to pay each month towards your student loans. Once you have a budget in place, look for ways to reduce your expenses and increase your income. Consider negotiating bills, cutting unnecessary expenses, or taking on additional work. Even small changes can add up over time and help you pay off your loans more quickly. Sticking to your repayment strategy can be challenging, but there are several things you can do to stay on track. Consider setting up automatic payments to ensure that you never miss a payment. If you have multiple loans, focus on paying off the loan with the highest interest rate first. Celebrate your progress along the way, and don't be afraid to adjust your strategy if needed. Chapter 4: The Benefits of Early Repayment. Paying off your student loans early can offer many financial benefits. In this chapter, we will discuss the advantages of early repayment, including reducing interest charges, improving credit score, and freeing up cash flow. One of the most significant benefits of early repayment is reducing the amount of interest you'll pay over the life of your loans. By paying more than the minimum required each month, you can reduce the principal balance of your loans faster, which in turn reduces the amount of interest that accrues. The longer it takes to pay off your loans, the more interest you'll ultimately pay, which can add up to thousands of dollars over time. Another benefit of early repayment is that it can help improve your credit score. Your credit score is a measure of your creditworthiness and is used by lenders to determine whether to extend credit and what interest rates to offer. Paying off your loans early can help improve your credit utilization ratio, which is the amount of debt you owe compared to your credit limits. Lowering your credit utilization ratio can help boost your credit score, making it easier to qualify for loans and credit in the future. Paying off your loans early can also free up cash flow, which can be used to pursue other financial goals or improve your quality of life. By reducing your monthly loan payments or eliminating them altogether, you'll have more money to put towards savings, investments, or other expenses. This can help you achieve financial stability more quickly, which can provide peace of mind and reduce financial stress. There are several strategies you can use to accelerate your repayment and achieve the benefits of early repayment. These include making extra payments. Making extra payments beyond the minimum required each month can help reduce the principal balance of your loans faster, reducing the amount of interest that accrues. Refinancing. Refinancing your student loans can help you get a lower interest rate, which can save you money over the life of your loans. Applying windfalls. Applying windfalls, such as tax refunds or work bonuses, towards your student loans can help you pay off your debt more quickly. Chapter 5: How Student Loans Affect Your Financial Health. Student loans can have a significant impact on your overall financial health. In this chapter, we will discuss how student loans affect your credit score, debt-to-income ratio, and ability to save for the future. Your credit score is an essential factor in your financial health, and student loans can play a significant role in determining your score. Late or missed payments can have a negative impact on your credit score, which can make it more difficult to qualify for credit in the future, and can result in higher interest rates. If you're struggling to make your payments, it's important to contact your loan servicer to discuss your options, such as income-driven repayment plans, deferment, or forbearance. Your debt-to-income ratio is the amount of debt you have compared to your income. Student loans can significantly impact your debt-to-income ratio, which can affect your ability to qualify for other loans, such as a mortgage or a car loan. If you have a high debt-to-income ratio, it may be more challenging to get approved for these loans or to get a competitive interest rate. Paying off your student loans early or using income-driven repayment plans can help lower your debt-to-income ratio. One of the biggest challenges of having student loans is that they can make it difficult to save for the future. If a significant portion of your income is going towards your student loan payments, it can be challenging to set aside money for other goals, such as retirement or a down payment on a home. To address this, consider creating a budget that prioritizes your student loan payments while also allowing you to save for the future. You can also explore options such as refinancing to lower your interest rate, which can help reduce your monthly payment and free up more money for savings. Managing your student loan repayment while also saving for other financial goals can be challenging, but it's essential to maintain a healthy financial balance. Consider setting specific financial goals for both student loan repayment and other areas, such as retirement or emergency savings. Then, create a plan to balance your payments towards your loans with your other goals. You may need to adjust your budget or explore options such as refinancing to make this balance work. Chapter 6: Student Loans and Career Advancement. Student loans can have a significant impact on your ability to advance in your career. In this chapter, we will discuss how student loans can affect your job prospects, career advancement opportunities, and overall financial success. When employers review job applications, they often consider an applicant's credit history and debt-to-income ratio. If you have a significant amount of student loan debt, it can impact your ability to get hired, especially if you have a high debt-to-income ratio. Some employers may view high levels of debt as a sign of financial instability, which can make you a less desirable candidate. Additionally, some professions, such as law and finance, may require a credit check as part of the hiring process. Student loans can also impact your ability to advance in your career. If you have a significant amount of debt, it can make it challenging to take career risks, such as starting your own business or pursuing a job with a lower salary but better long-term prospects. Additionally, if you're struggling to make your student loan payments, it can create stress and anxiety, which can negatively impact your job performance. Addressing your student loan debt and creating a repayment plan can help alleviate some of this stress and allow you to focus on your career goals. Finally, it's essential to recognize the impact that student loans can have on your overall financial success. If you have a significant amount of debt, it can take years or even decades to pay off, which can delay your ability to save for other goals, such as a down payment on a home or retirement. Additionally, high levels of debt can increase your stress and anxiety, which can impact your mental and physical health. Addressing your student loan debt can help reduce this stress and allow you to focus on building long-term financial stability. Chapter 7: The Cost of Student Loan Forbearance and Default. While struggling to make student loan payments, it can be tempting to request forbearance or enter into default. However, both of these options can have significant long-term financial consequences. In this chapter, we will discuss the costs associated with student loan forbearance and default. Student loan forbearance is a temporary postponement of payments allowed under certain circumstances, such as unemployment or financial hardship. While forbearance can provide temporary relief from student loan payments, it's essential to understand the long-term cost. During forbearance, interest continues to accrue, and the total cost of your loan can increase substantially. This means that when you resume payments, you may owe significantly more than you did before entering forbearance. Additionally, forbearance does not address the underlying issue of repayment, and it can delay progress towards paying off your student loans. Default occurs when you fail to make payments on your student loans for an extended period, typically 270 days or more. Entering default can have significant long-term consequences, including damage to your credit score, wage garnishment, and even legal action. Default can also result in additional fees and penalties, increasing the total cost of your loan. If you default on your student loans, it can be challenging to get back on track, and the impact on your credit score can last for years. While forbearance and default can seem like viable options when struggling to make student loan payments, it's essential to consider the long-term costs. Instead, explore alternative options such as income-driven repayment plans, loan consolidation, or refinancing. Additionally, it's essential to communicate with your loan servicer and explore options such as deferment or a temporary hardship forbearance. By proactively managing your student loan repayment, you can avoid the long-term costs of forbearance and default and work towards long-term financial stability. Chapter 8: Strategies for Managing Private Student Loans. Private student loans can be an attractive option for students, but they can also be more challenging to manage than federal student loans. In this chapter, we will discuss strategies for managing private student loans and minimizing the impact on your financial health. Private student loans often have more stringent repayment terms than federal student loans, so it's essential to understand the terms and conditions of your loan agreement. Before accepting a private student loan, review the repayment terms, including interest rates, fees, and payment schedules. Make sure you understand the consequences of missed or late payments and any options for deferment or forbearance. Refinancing your private student loans can be an effective way to lower your interest rate and reduce your monthly payment. By refinancing, you may also be able to consolidate multiple loans into a single payment, making it easier to manage your debt. However, it's essential to consider the long-term costs of refinancing, including any fees or penalties associated with early repayment. Shop around for the best rates and terms and consider working with a reputable lender to ensure that you get the best deal. Private student loan servicers may offer alternative repayment plans that can help you manage your debt. These plans may include graduated repayment, extended repayment, or income-based repayment. Each plan has its own set of requirements and eligibility criteria, so it's essential to research and compare your options before selecting a plan. If you're having trouble making payments on your private student loans, it's essential to communicate with your lender. Many lenders offer options for deferment or forbearance, as well as repayment plans based on income or financial hardship. By proactively communicating with your lender, you may be able to avoid default and the associated consequences. Chapter 9: Resources for Paying Off Student Loans. Paying off student loans can be a long and challenging process, but there are many resources available to help borrowers manage their debt and achieve financial stability. In this chapter, we will discuss some of the most valuable resources for paying off student loans. The U.S. Department of Education's Federal Student Aid Program provides a range of resources and services to help borrowers manage their student loan debt. These resources include information on repayment options, loan consolidation, and forgiveness programs. Federal Student Aid also offers a loan simulator tool that can help borrowers estimate their monthly payments and total loan costs. Loan servicers are companies that manage student loan accounts on behalf of lenders. If you have federal student loans, you can contact your loan servicer to access information about repayment options and loan forgiveness programs. Loan servicers can also provide guidance on how to manage your loan payments and avoid default. Several nonprofit organizations offer resources and services to help borrowers manage their student loan debt. For example, the National Foundation for Credit Counseling offers financial counseling services to help borrowers develop a repayment plan and improve their overall financial health. The Student Borrower Protection Center is another nonprofit organization that provides information and resources to help borrowers navigate the student loan system. Some employers offer benefits to help employees pay off their student loans. These benefits may include loan repayment assistance or employer contributions to a 401 retirement plan. Check with your employer to see if they offer any student loan repayment benefits. Several states have created programs to help borrowers manage their student loan debt. For example, the Maryland Higher Education Commission offers a loan assistance program that provides financial assistance to borrowers who work in certain fields. Check with your state's Department of Education or Higher Education Commission to see if there are any programs available in your area. Chapter 10. Conclusion: Take action to pay off your student loans. In this book, we've discussed the many reasons why paying off your student loans should be a priority. From the financial benefits of early repayment to the long-term impact of student loan debt on your financial health and career advancement, there are many compelling reasons to make paying off your student loans a priority. We've also discussed various strategies for managing and repaying your student loans, including building a repayment strategy, taking advantage of early repayment benefits, and managing private student loans. In addition, we've explored valuable resources for borrowers, such as federal student aid, loan servicers, nonprofit organizations, employer benefits, and state programs. However, the most important message of this book is the importance of taking action to pay off your student loans as quickly as possible. While there is always the possibility of federal loan forgiveness, it is not a guaranteed solution. Relying on the government to forgive your loans could lead to years of financial insecurity and stress, as well as missed opportunities for career advancement and financial stability. Instead, we encourage you to take the advice and strategies presented in this book and develop a comprehensive plan to pay off your student loans as soon as possible. Whether you choose to pay off your loans aggressively, take advantage of early repayment benefits, or utilize resources such as loan servicers or nonprofit organizations, the key is to take action and make paying off your student loans a priority. By prioritizing your student loan debt and taking action to pay it off, you can achieve financial freedom and minimize the long-term impact of student loan debt on your financial health and overall well-being. We encourage you to take the first step towards financial stability and start paying off your student loans today. This book that was authored by OpenAI's ChatGPT. With the company taking on billions of dollars in investments, this is the perfect time to find out ways for this innovative tool to help you learn how to start paying off your student loans. Audio for this book was provided by NaturalSoft Limited's Natural Reader AI software using their commercial license. Per their website, this license allows you to use its software and voices for commercial or public use. This includes, but is not limited to, YouTube videos, public announcements, broadcasts, and e-learning.